Okay, now let's look at the merchandising cost flow in the accounting cycle. This slide here shows the flow of merchandise costs during a period and where these costs are reported at the period end. Recorded beginning inventory plus net cost of purchases is the merchandise available for sale. As inventory is sold, its cost is recorded as cost of goods sold on the income statement. What remains is the ending inventory on the balance sheet. You should note that a period's ending inventory will become next period's beginning inventory, and so on. Adjusting entries are generally the same for merchandising and service companies, including those for prepaid expenses, accrued expenses, unearned revenues, and accrued revenues. However, a merchandiser using a perpetual inventory system is usually required to make another adjustment to update the merchandise inventory account to reflect any loss of merchandise due to theft and deterioration. Shrinkage is the term used to refer to the loss of inventory, and it is computed by comparing a physical count of the inventory with the recorded amounts. A physical count means the company will send somebody to the warehouse and count the amount of existing inventory. A physical count is usually performed at least once annually. The physical count amount is then compared to the amount recorded in the accounting system. Any differences will be adjusted at the period end. To illustrate, Sapmart's merchandise inventory account at year-end 2011 has a balance of 21,250. But a physical count reveals that only 21,000 of inventory exists. The adjusting entry to record this shrinkage will be a debit to cost of goods sold and a credit to merchandise inventory for $250. So the shrinkage increased the cost of goods sold in the current period, and the merchandise inventory account is updated to the appropriate amount. Closing entries are similar for service companies and merchandising companies using a perpetual inventory system. The difference is that we must close some new temporary accounts that are arising from merchandising activities. Sapmart has several temporary accounts unique to merchandisers: sales, sales discounts, sales returns and allowance, and cost of goods sold. Their existence in the ledger accounts means that the first two closing entries for a merchandiser are slightly different from the ones described in the previous chapter for a service company. These differences are highlighted in red here. In the income statement of a merchandiser, there are three main parts. Gross profit, determined by net sales less cost of goods sold. Profit before tax, determined by gross profit less other expenses. And profit after tax, or net income. Net sales is sales minus cost. Net sales is sales minus any sales discounts and sales returns and allowance. After deducting cost of goods sold from net sales, we have gross profit. Selling expenses or distribution costs include the expenses of promoting sales by displaying and advertising merchandise, making the sales, and delivering goods to the customers. Administrative expenses support a company's overall operations and include expenses related to accounting, human resource management, and financial management. If there are financial items such as interest revenues and interest expense, they should be shown in separate categories on the face of the income statement. The merchandiser's classified balance sheet report the merchandise inventory as a current asset, usually after accounts receivable, according to its liquidity ranking. Inventory is usually less liquid than accounts receivable because inventory must first be sold before cash can be received from the customers. But merchandise inventory is more liquid than supplies and prepaid expenses. This slide shows the current asset section of SAP Mark's classified balance sheet. In this chapter, we would like to introduce the asset test ratio. Similar to current ratio, it is a common ratio that is used to determine the liquidity of a company. In other words, this ratio determines if the company has enough liquid assets to cover the current liabilities. The ratio is calculated as quick assets divided by current liabilities. Quick assets are those current assets that can be converted into cash quickly. They usually include cash, short-term investments, and receivables. A common rule of thumb is for the asset test ratio to be at least 1, but this can vary from industry to industry. One more ratio to introduce here is the gross margin ratio, which is another common profitability ratio that calculates the percentage of dollar sales available to cover expenses and provide a profit. This ratio is calculated as gross margin divided by net sales. Remember that gross margin is calculated as net sales minus cost of goods sold. In most cases, the higher this ratio is, the better. The slide here shows the information about Lastel for the fiscal years from 2006 to 2010. For Nestlé, the gross margin ratio was consistent for the 5-year period at about 58%, but dipped slightly to 57% in 2008 to cover all other expenses and still produce a profit. This decrease is an important signal to the management. Success for merchandisers such as Nestlé depends on adequate gross margin. This comes to the end of session 4 and also the end of chapter 5. Now you can try the concept quiz to test your understanding of this session.